All right, welcome. Today we're going to break down the core principles of investment strategy. Now, I know it can sound super complex, right? But it really just boils down to a few key ideas: risk, return, and maybe the most important one, timing.
So, to really get to the heart of this, we're not going to start with boring spreadsheets or confusing charts. Nope. We're going to start with a story about a village, a vault full of coins, and a very unexpected, very fiery problem. It's a great way to wrap our heads around some really powerful financial ideas.
So our story kicks off in this village called Aurelia. The guild, who are kind of like the guardians of the village's money, had this vault just packed with coins. But their planner, a pretty smart person, points out something crucial. Money that's just sitting there is actually losing money. Inflation. It's a real thing, even in a fantasy village. The value of their savings was just slowly draining away. They had to do something. But what kind of plan? Well, right away, a bunch of different ideas pop up. You've got the risk taker, who wants to go for huge profits with exotic gems. And then you've got the watcher, who's worried about losing everything. And this is that classic tug-of-war you see with any investment decision, right? The thrill of a huge return versus the need to, not lose your shirt. So, instead of betting it all on one thing, they decided to experiment. They spread their coins around in a few different places. The idea was simple. If one thing went wrong, maybe the others would be okay. It was their first step towards building a portfolio that could actually handle a few bumps in the road. Okay, so first up, they lent some coins to the local farmers. The farmers would pay them back, plus a little extra. This is a fantastic analogy for what we call bonds. You're basically lending out your money, and in return you get a steady, predictable payment. It's generally seen as a pretty low-risk, stable kind of investment. All right, next, they decided to get a little bit riskier. They invested in these merchant caravans heading off to faraway lands. And this is a great stand-in for equities, or what you probably know as stocks. You're buying a piece of the action, a share in the whole adventure. The potential for a huge payoff is there, for sure, but so is the risk of losing everything you put in.
And last but not least, they didn't just put their money into promises or far-off journeys. They bought actual physical stuff, things like grain and iron. We call these real assets. Look, they're probably not going to make you rich overnight, but they hold their value. They're tangible, physical things you can count on, especially in a crisis.
So this table here, it lays out their whole diversified strategy perfectly. See? They weren't putting all their eggs or coins in one basket. They've got their low-risk loans to farmers, the high-risk, high-reward caravans, and those stable real assets. On paper, this looks like a really solid, balanced plan. But, as we all know, no plan ever survives contact with reality, right? The real world, or, the fantasy world in our story, is just full of curveballs. And just when the guild was feeling pretty good about their setup, their strategy was about to face a fiery test. And that unexpected event, it came in the form of a dragon. This one single catastrophic event changed everything for Aurelia, like overnight. The fields were toast, and the entire economic foundation of their village was just rocked. And here is the really crucial part. The farmers, with their fields completely scorched, couldn't pay back their loans. All of a sudden, the guild's safe investments, their bonds, were worthless. They had zero cash coming in right when they needed it the most to repair shields and help people out. What they were facing was a classic liquidity crisis. So, in the language of finance, our dragon is basically investment risk. It was a totally unforeseen event that caused a huge financial loss. To be more precise, it was a credit shock. The people who owed the money suddenly couldn't pay, and their safe assets completely failed them. This whole disaster led the planner to have this major breakthrough. A great investment strategy isn't just about balancing risk and reward. It's about matching what you have with what you might need. Your assets have to line up with your liabilities. It's all about timing. And this, right here, brings us to the absolute core concept of our story, asset-liability matching, or for short, ALM. It's basically a strategy all about making sure you have the right kind of cash on hand at the right time, so you can pay for what you need to pay for, whether that's repairing shields or paying out a pension. Okay, so this diagram you're seeing, the actuarial control cycle, it's a perfect picture of this new way of thinking. It's not a set it and forget it kind of thing. It's a continuous loop. So let's walk through it with our story. First, you specify the problem.
For the Guild, that was realizing, hey, we need cash right now for things like shield repairs. Then you develop a solution. That's them coming up with their new rebalanced investment plan. But then, and this is the most important part, you monitor the experience and adjust. That dragon attack, that was a huge, unexpected experience that forced them right back to the beginning of this cycle to create a way smarter strategy.
Now, when you get this wrong, when you have what's called an ALM mismatch, the results can be, well, pretty disastrous. You could be forced to sell off your long-term investments, like those merchant caravans, at a terrible loss, just to get some quick cash. And when it comes down to it, you risk not being able to keep your promises, and that just shatters all trust and confidence.
So all of this thinking led the Guild to a new, much smarter, three-step strategy. First, they split up their money based on when they'd need it, short-term versus long-term. Second, they matched those needs with the right kind of assets. And third, they stuck with that super important idea of diversification to make sure no single dragon could ever wipe them out again. And you know, the whole point of this new rebalanced plan was actually incredibly simple, but also really powerful. It was all about making sure that, no matter what, whether it was a dragon attack or a bad harvest, the Guild could always keep its promises to the people of Aurelia. Okay, so let's do a quick recap and map our story directly to the real-world financial concepts. The Guild's coins are the investment funds. Lending to farmers, that's your bonds. The caravans are equities. That devastating dragon attack is investment risk. And the Guild's brilliant solution? That's asset-liability matching. So, why should you care about a story with a dragon? Because these ideas, ALM, diversification, the risk-return trade-off, they aren't just fantasy. They're the absolute foundation of modern finance. You're going to see them on professional exams, and they are critical for anyone managing huge piles of money, like you'd see in a pension fund or an insurance company. All right, quick pop quiz to make sure this all landed. Think back to the story for a second. Why couldn't the Guild just dump all their coins into those high-return merchant caravans? What was the problem?
That's it. You got it. Their liabilities, what they might need to pay for at any moment, like fixing shields, were short-term. But the caravans, that was a long-term, illiquid investment. You can't just cash it in. You can't pay for today's emergency with a promise of profit a year down the road. It was a textbook asset-liability mismatch. And that really brings us to the final thought I want to leave you with. Every single one of us, every company, every big pension fund, we all have potential dragons out there, those totally unexpected events that can mess up even the most careful plans. So the real question is, what are the dragons your investment strategy is prepared for?